My guest today is Thomas Key, and we're talking about risk. Hi, Thomas.
Hi.
Let's talk about risk. How can we control it, or be prepared for it at least?
Well, you have to take steps to manage your risk and manage your expectations as you also manage your investments. And I like to advise my clients to plan for the worst every step of the way. Traditionally, investors like to chase performance. Mutual funds are a great example. People like to look for the best performing mutual fund. Well, I think we all know that the best performing one year not likely to be the best performing the next. I advise my clients to do the exact opposite. Instead of chasing performance, I want them to chase risk control.
Doesn't that cause or call for at least a change in mindset?
It's a complete change in mindset. In fact, it's a challenge. It's a challenge for someone to prepare to not be correct. But it does some things that are interesting. First thing that it does is it makes sure that you're never surprised. If the market turns against you, you're never caught off guard. You're always in control of your risk. You're always paying attention to your disciplines. And as traders, we need to adhere to our disciplines. But above that, it also does something else that's very, very important. When you are right, you can actually appreciate it again. Instead of being relieved you weren't wrong, which I think as adults we get to that point sometimes, we're actually relieved when we're not wrong, that being when we're right, instead of being happy like we were when we were kids. Now we can actually appreciate it again too. So when we prepare for the worst, when we're chasing risk control instead of performance, we can not only be prepared for anything, but also be pleasantly surprised when things work in our favor.
Can you give me an example, real world, of how you use that?
Absolutely. I had a reversal signal that happened late in April, and that reversal signal said sell all of our long positions and turn short. And so we went aggressively short. We bought the VXX, which is the double-weighted VIX. We bought it the double-weighted short on the Russell, which is TWM, SRS, the double-weighted short on the real estate, and then we also bought SKF, which is double-weighted short on financials.
And those double weighted are very, very aggressive.
They are, but each one was associated with strict risk controls. So we enter them as the market's moving higher without fear, because if we're wrong and we're planning for the worst here, we're going to be out, we're going to just lose a little bit, right? But instead, the market turned down and fell 1,000 points a week and a half later. And with that, we could be pleasantly surprised. I mean, anyone really would be. This is an extreme example. No one expects a 1,000-point decline, but the simple fact of the matter is we were prepared for a risk and pleasantly surprised at the result because we were chasing risk controls and not performance.